Is SIP 100% safe? Let's find out through a detailed analysis in this video. Can we get started? SIP is now a popular investment strategy and it has now become a beneficial investment for a lot of investors. But is mutual fund SIP 100% safe? Any investment is not 100% safe. There is no such thing as no risk or risk-free. In fixed deposits, there is a risk of inflation and it is not good enough to beat inflation. If we take the case of direct stocks, there is market risk and market volatility. Mutual funds mostly invest in stocks or investments like FD. Before analyzing whether SIP is safe, we have to understand one important thing about SIP. SIP is not a scheme. SIP is an investment strategy. The mutual fund scheme that we choose to use SIP, that mutual fund scheme invests in assets and the risk is according to that. For example, in equity fund, there is market risk. And there is also a risk of your principal amount declining in a short term. But the chances of your principal amount decreasing in debt funds is less. So debt funds has no risk? No. We can't say like that. The interest is low in debt fund and it will not beat inflation. So there is an inflation risk. Even though mutual fund SIP has risk like all other investments, why it is so popular? Because SIP is a strategy that reduces risk in mutual funds and it also increases the safety quotient. But how? For example, if someone invests in equity mutual fund through SIP, he is doing a regular investment. For example, he or she starts investing when the market is high. Then the market goes down. There is also investment. Then the market recovers. And he or she is still regularly investing. So what happens if someone keeps investing in all the market highs and lows? So when an investor is investing in all the market phases during the ups and the downs and again the ups and the downs, even though he is investing the same amount, he gets a lot of units at a discounted rate during a market down. So it is a profit, right? And that's what is happening here. So an investor is buying a lot of units when the market is down and his portfolio will automatically grow when the market is up. So overall, the SIP strategy will be helpful in investing in average price constantly, compared to investors who do a lot of technical and detailed analysis before investing in a scheme. Investors who invest using the simple SIP strategy is getting more returns. So we have seen how SIP increases the safety quotient. How can it be increased even more? You have to find which fund you are going to use this SIP strategy. If you choose that wisely, you can increase the safety quotient even more. When you are investing in SIP, you can invest in diversified equity funds. In sector-specific equity funds or thematic equity funds, the risk is high because the fund manager can only invest in that particular sector or scheme. So if you invest in actively managed diversified equity fund, in the future, if the outlook of a particular sector is negative, the fund manager can come out and invest in another different sector. As there is diversification in lot of sectors, if one sector underperforms, they can decrease the exposure and increase the exposure to the sector which is doing well. Another good thing is that this will be done by the fund manager and you don't have to worry about it. So the sector specified funds have more risk compared to actively managed diversified equity fund. And what can be done other than this to increase the safety quotient? Don't do SIP in NFOs. NFO is new fund offers. I'm saying this because as these funds are new and they don't have a track record, we cannot analyze how it's gonna perform, how they will impact our portfolio, what strategy they use, and how they will perform when the market is up and how they would manage when the market is down. We are basically clueless about them. So it is better to avoid starting SIP in NFOs. Okay, now you know that you should avoid sectoral funds and NFOs. But what fund should you prefer to start SIP? To beat inflation, you have to do SIP in equity fund. But remember to choose a fund with a good track record. Choose a fund with a minimum 3 years. There's also a lot of funds available in the market with 5-year and 7 years track record. You have to analyze whether the fund has performed consistently in the past. Don't get carried away by recent performance. Look for long-term consistent performance. There should be a qualitative analysis of how the fund will perform in the future, and it should be done with a futuristic view. A financial planner or a mutual fund distributor is the best person to help you with this analysis. So avoid sectoral and NFO funds while investing in SIP, and choose a fund which has consistently performed well and which will most probably perform well in the future. I will meet you in another video with some exciting information. Thank you. Are you in search of a personal guide who can remove the stress of handling your finances? Then please feel free to avail our expert consultation, and also you can attend our webinars to gain investment related insights. Both the consultation and webinar are absolutely free, and you can find the link in the below description. Please like and share, and do subscribe to Holistic Investment.